Fidelity. The entire thing was just institutions. It's next level. This industry is going to the next level. And guys, I don't know what else to say. I'm bullish.
You said it. You finally said it.
I'm so bullish.
Andy's bullish. I'm bullish. We're bullish. We're going to the top. We're on 4th floor today. We're going to be on floor 1, and then we're headed straight to the moon, boys.
Alrighty. Happy Thursday.
Happy Thursday indeed.
Happy Thursday to all my uranium holders. Cheers to you guys. If you're holding crypto, I'm sorry.
We successfully shook Andy out of the coins. It's time.
I mean, I've been shook out since like November mentally.
A few days ago, didn't we have you on the stream saying you were back? You're a Bitcoin bull. We had convinced you.
Yeah, every time Vance and Michael come on, I get bowled up and then I lose money. It's kind of sad.
All right. Well, how
about that gold candle? How about that gold candle from 5,500 to 5K? Apparently, there's going to be a lot of shortages in these markets for actual paper receipts versus the physical markets. We'll see, dude. So the SEC and the CFTC are having an event today as well that our friend is moderating.
Our friend.
Yeah. What's her name again? Eleanor.
Ah, yes.
She's moderating it.
Shout out Eleanor. She's great. She told us a story of how she got into crypto through, she was at a traditional mainstream legacy media company. She wanted to cover the space. They didn't let her. She got an invitation. I think it was from David Sachs to come.
Really?
I think so. I might be misremembering, but it was around the time of the inauguration, I believe. I don't remember the exact timing, but I believe she got an invitation to come to the White House when there was some crypto things happening, and the legacy media company would not let her go and cover as a journalist. And and she said, "Fuck them," and she went anyway. Badass.
That's bullish.
Yeah, she went anyway, and then got very involved in the crypto space. Was no longer part of the legacy media company, and ended up making a name for herself. Covering the space. So shout out Eleanor.
Yeah. I mean, I think the goal of the meeting was to kind of get clarity on the market structure bill and try to get the CFTC and SEC together to like unite forces. Basically to try to figure out how they can best create this, crypto capital of the world that they're trying to create. I don't really know, man. But I don't really see anything getting done there for still a long time. Brian Armstrong was on CNN, I think, or CNBC, saying that there's literally banks behind the scenes lobbying against crypto, like full on against crypto.
We know
with like a lot of money. So Yeah, there's definitely a big fight going on. Let's just put it that way.
But it's interesting to see how the White House, the regulators, and the crypto community are all aligned in fighting against the banks. Like
Mm,
Trump literally sued JP Morgan for $4 billion because he got debanked during his
yeah.
whole political crash out phase. So Trump is not a fan of the banks. The people he appointed are not a fan of the banks. Like David Sachs is a crypto czar, he's not a banking czar. And
No.
so, like he said, I mean, if none of this clarity stuff goes through,
Yeah.
they can pay rewards and interest on stable coins because it's in the Genius Act.
Right.
It's framed as rewards and it's kind of funky. And so they would kind of have to backdoor into it. But you know, that is the way that they could pay interest. They don't need the clarity. The crypto companies and stablecoin providers don't need the Clarity Act to do it. I think something that's more interesting that came out in this regard that came out this morning was uh, there was a piece put out about Tether
Yep.
and how Tether didn't want this to go through. They actually separated themselves from Coinbase and they were not in favor of paying interest on stablecoins because that would eat into all of their net interest margin. That's their entire business model. And
Mhm.
if it became standard practice for them to share that income with retail stablecoin holders, they would have significantly smaller profit margins.
That's
Um,
so funny, man.
it turns out that wasn't true. Palo and Tether
Oh,
actually didn't say that. There was some piece put out by a law firm that ended up kind of fabricating this, and then there was a later piece just a few hours afterwards that came out in the block saying how they don't really have a dog in this fight
yeah.
um, because they don't pay interest on their stable coins. So I think it's it's interesting to watch this all unfold. You know, there was a vote by the Senate Agriculture Committee. I think the reason it's the
Yeah.
Agriculture Committee is because these are commodities.
Yep.
Um, and I think that went well, but again, we know that there's significant pushback by the banks and then also by Coinbase. And I'm sure there's other crypto companies that are on the side of Coinbase as well. But it did go to a vote, and I think the vote went through. So we'll have to wait and see as far as what the next steps are.
Yeah, man. Definitely. Well, we've got our first guest coming up today. Olivia, she runs tokenization at Alva Labs. She was recently on CNBC, amongst other news platforms, talking about tokenization and more. Excited to have her on and discuss what she's doing from the tokenization side at Avalanche and more of obviously the Avalanche ETF also just went live today or this week, VAVX. So why don't we get Olivia up and talk tokenization? What do you say, Rob?
Let's do it. Here she is. Olivia,
Hey
welcome to the
guys,
Olivia,
show.
so nice to meet
welcome,
you. I'm
welcome.
thrilled to be here.
Absolutely. We're big fans of tokenization, and Avalanche has I think been flying under the radar for a little while, but it's no surprise that you guys are up there with, the biggest names in tokenization. Um, it's incredible. Can you just give us a sense of like what you've been up to? Because
Yeah,
it seems as if you've been quite busy here over the last weeks and months.
yeah, sure thing. Well, first of all, thank you so much for having me on the show. Really excited to talk about what we're up to on the Avalab side. First off, just for those who might not know, Avalabs is a software development company supporting the growth and adoption of the Avalanche ecosystem. Avalanche is a network of layer one blockchains that are purpose built for any industry or use case, be it FIFA's L1 related to tokenized collectibles, or be it Avalanche L1s that we've run in tandem with big names like JP Morgan, et cetera. So that's what Avalabs is. In my role, I'm focused on all things tokenization within financial services. So what that looks like is, on the one hand, partnering with leading financial institutions to bring institutional grade assets on chain. So think top tier issuers like the Franklin Templetons, the BlackRocks, the Apollos, the KKRs, the Van Ex, Libera, Wellington Managements of the world, and bringing their tokenized assets to Avalanche. And then where I'm really laser focused and where our team is really laser focused is on connecting those assets to distribution channels where capital already flows, be it fintechs with an appetite for stablecoin yield products or tokenized US equities infrastructure, or allocators such as family offices, liquid funds, etc. And prior to joining Avalabs, I was actually on the TradFi side. I was investing in mid-cap banks at T. Rowe Price Group, but I was very involved in the digital assets working group there.
Very cool. And one of the reasons that prompted this conversation was you guys have record activity. Saw daily active addresses hit an all-time high of 1.71 million on Avalanche. Total assets exceeding $3.5 billion in stablecoins and real-world assets. Galaxy Digital launched a $75 million tokenized loan obligation on Avalanche, and then Grove is planning a 250 million RWA deployment on the network. Give us a sense of what it takes to progress these from just an idea in these, we like to call these, these are like institutions that are kind of crypto curious and they're starting to, wet their beak and get in the game. Give us a sense of like how these deals are made, right? Like I take it you probably have some, institutional networks and relationships, and you kind of have on, some people at, the Galaxy Digitals and the Groves of the world. How do these deals ultimately come together from the ideating phase to, money being deployed on chain?
I mean, I would say, first of all, not all institutions or fintechs, as we call them, are created equal. And so you have some of the more progressive players like forward-thinking asset managers, such as the Apollos of the world, that have been very active in bringing assets on chain, in getting more involved with DeFi. And so that experience looks very different than some of the more, what I call like traditional financial institutions that are just dipping their toes in the space, as of this year. So obviously, it depends on where they are in their educational journey, but what our work is focused on is serving as trusted advisors or consultants really that work with these institutions, understands what their actual pain points are, and then where blockchain technology can, in fact, solve some issues or maybe not solve issues. And so a lot of our work, starts with understanding what the pain points are, working with our network of tech enablement partners to effectuate whatever the identified, mutually identified solution may be. But I'd say a lot of it is education, going into these institutions, having educational sessions, Q&A sessions for 45 minutes to an hour, fielding their inquiry, inquiries about what we're doing, what institutions we've worked with, some of the work we've done with Citi on-chain FX pricing and execution in the past, some of the work we've done with MAS's Project Guardian, and so on. And so much of it's education, but then once we identify the problem that can actually be solved by blockchain technology, and then the tech enablement partners that can help, resolve whatever the issue is at hand, be it our tokenization platform partners like Centrifuge or Securitize, with whom we've done a lot of work on everything from tokenizing KKR's Healthcare Growth Fund to more recently bringing Janice Henderson's JAAA, JTRSY products into the Avalanche ecosystem through Centrifuge. Some of it's working with Oracle providers. Some of it's working with dev shops that can help, these teams crystallize whatever vision they have in mind. So that's where the bulk of the work is really, putting the puzzle pieces together on the tech enablement side for these institutions who may be, again, dipping their toes in the space or may have some experience in the space, but aren't necessarily sure on how to execute certain visions.
Yeah. 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 There's definitely an education gap happening, and I've seen quite a few of your posts on LinkedIn. I think that you're doing a great job there as well. I'm just trying to basically educate on stable coins, credit, um, all the all different types of on-chain products. I saw that you were at Davos, or you were talking about Davos recently. I'm curious kind of what insights you took from there as well. What surprised you the most about how institutions are thinking about stable coins, credit creation, these types of things? I don't know if you were there or not.
So
Were you?
I was not there on the
Yeah.
ground, but our Avalanche Policy Coalition team was there. But I tuned into all of the panels, was glued to my screen, as many of us were last week. But on that's a great question. I went in expecting more familiar territory.
Mm.
Much of these discussions in the past have focused on payments efficiency, compliance frameworks, regulatory guardrails. Instead, I was most surprised to hear central bankers, bank CEOs, executives openly wrestling with a far more, in my view, consequential shift, which is the growing realization that credit creation may no longer be anchored exclusively to bank balance sheets. And so to understand why that matters, and I wrote about this and I talked about this on, NYSC last week, is to consider how traditional banking works. So it bundles two functions together. You're holding your money, you're lending it out. When you deposit funds, the bank keeps a fraction in reserve and lends the rest. And that's what we call fractional reserve banking. And it's how credit gets created. Stable coins work differently, and they're fully reserved by design. A dollar in means a dollar held, typically in short-term treasuries. There's no lending, there's no multiplication. And so, as trillions in transactional value, migrate onto stablecoin rails, the credit obviously doesn't vanish, it relocates. Some of it's in capital markets, private credit funds, programmable lending protocols that, again, sit outside the perimeter of the traditional banking system. And so that shift came into sharp focus during the panels on tokenization, stable coins. And there was, one particular panel and Q&A session when a chief economist from one of Brazil's largest banks asked the question on everyone's mind: what happens to leverage and what happens to monetary policy transmission when stablecoins dominate transactional money? And so Coinbase's Brian Armstrong's answer, was pretty blunt. He was talking about under the Genius Act, stablecoin reserves must be held in short-term treasuries, 100% reserve, no fractional component. And so if customers want yield beyond that, they choose to lend their money out explicitly. And as he put it, it flips the banking model on its head. And it was interesting to see the governor of the Bank of France push back, not so much on the mechanics, but his concern was more historical. And he was talking about how monetary systems dominated by private money have collapsed before. And he pointed to the US in the 19th century, before the Federal Reserve existed, when banks' panics were routine and confidence was more fragile. And so for him, the question wasn't so much about whether stablecoins function technically, it was more so about whether a monetary system can in fact remain stable without public money as its anchor. And so that
Yeah.
disagreement, it was what gave, like, and I think a lot of you probably saw this, but the interest debate a lot of intensity. It's like more than a technical question on, should stablecoins pay yield? It's
Mm.
underneath of it, it's really a debate over who controls, credit creation going forward.
And it's an incentive to bring everyone further into this stable coin direction, which we're seeing the tension. Like, it would be bringing them out of the traditional banking system, and more into, the stable coin, fully reserved, fully backed system.
Mhm.
The question in my mind is like, isn't that super deflationary for the currency?
Mm.
Because, right, credit creation adds money to the money supply. We end up increasing the money supply. Supply and demand causes inflation. If we take leverage out of the system and all of a sudden, the money multiplier isn't
Mhm.
above one, it's actually less than one until we bring all that money supply back to, fully what's in reserves. Like, is that not deflate? Help us, how should we be thinking about this? Is that not
Yeah,
very
and it was
deflationary for the dollar?
and interestingly, in another session, Jeremy Allaire was, arguing that as the marginal cost of storing and moving value on blockchain networks drops towards zero, future economies might generate similar output, but with a far smaller monetary base. And then similarly,
Mm.
I think the IMF Stan Katz agreed, noting that, this kind of velocity increase is more supply driven rather than demand driven, which could mean a smaller
Mm.
monetary base without inflationary pressure. But I think all that's to say, the moment that really stayed with me came from Standard Chartered's Bill Winters, and his he put it, his bank doesn't really care which instrument wins. It could be stable coins, it could be tokenized deposits, it could be tokenized money market funds. What he said was that he wanted the customers to get the best thing for them. And so they just want to be the entry point and the exit point. And so that's, in my view, from the institutional side, the real posture now. It's not defending really the old architecture, but positioning to intermediate whatever replaces it.
Yeah. Well, then let's talk about some of those replacements. Then I think the big thing on folks' mind from this past week or two has been the launch of the BitGo IPO, and actually how Ondo was able to have it be traded on chain from the moment that it was launched. Not sure if it was on Avalanche. I think it was on Ethereum, BNB, Solana, maybe Avalanche. Maybe it is now. And we saw that this is kind of like this first of its kind tokenized equity being traded live with the IPO, right? Meaning anyone with a Phantom wallet, a MetaMask, a Rabi, et cetera, could trade this tokenized asset on chain. But there's kind of some issues with the way that tokenization is being done on chain right now, specifically around tokenized securities. You've made some pretty strong points around weakening of investor rights when it comes to tokenized securities. What does good tokenization of securities look like at the infrastructure level? And how do you think about this investor rights dilemma as it pertains to tokenizing different types of assets? Because we're also kind of in this context of crypto right now where everyone's trying to figure out what they own, what this token, what is it? What do I have claims to? What are my rights? But specifically with securities, it's a bit more black and white over there. However, in the tokenization process, you seem to think that there's some weakening of rights. How does that occur?
Yeah. And I would say this is super timely as just yesterday the SEC issued guidance, clarifying many of these issues. But I would say, first off, many of the tokenized securities products today on the market can give you weaker legal rights than traditional stock ownership, in my opinion. And so how you build it matters far more than the underlying blockchain technology. And SEC Commissioner Peirce, over the summer had written a really great, I guess it was memorandum saying that blockchain, doesn't have magical abilities to transform assets. Like the tokenized securities are still securities. And as I mentioned, the SEC just issued guidance this week clarifying exactly this point. The format doesn't change the law, but the structure you choose determines what rights investors actually get. And in my opinion, if you tokenize, incorrectly, you're rebuilding Wall Street's problems with higher costs. And if you architect correctly, you unlock all the promises we've heard of: instant settlement, lower capital requirements, programmable assets, and so on. And so it comes down to a spectrum. Like, are you getting a synthetic claim, a backed claim, or an actual share? And so just to step back, and Chuck at the Stablecoin Blueprint has written a lot of great literature on this, and I refer everyone here to it. But when you think about stock ownership and how it works today, when you buy Apple stock through Robinhood, you don't actually own Apple shares. You own a claim on the shares that sit in a chain of intermediaries. And so how it works is Apple's official shareholder lists one owner, it's seeding company, it's owned by the DTCC. The DTCC tracks clearing brokers like Morgan Stanley, who track retail brokers like Robinhood, who track you. And so each layer handles complexity for the layer below. And you get the economic benefits, dividends, voting rights, price gains, et cetera, but you're not listed as a shareholder on Apple's books. And so you hold a legal claim against your broker for shares. And interestingly, the system was actually created in 1973 because Wall Street was drowning in paper certificates. They literally had to close stock exchanges on Wednesdays to catch up on paperwork. And the solution was centralizing shares at the DTCC and settling through electronic ledger updates. And that was genuinely innovative for its time, because the DTCC could use netting to compress trillions in trades into billions in actual movement. And so that architecture for 1973's problems obviously now creates new limitations. You can't hold your shares yourself. Trading only happens during business hours. You can't use your shares as collateral in DeFi protocols. And so what solved that paperwork crisis 50 years ago now constrains what's possible with modern technology. And now flipping to present day with the tokenization models that are being proposed, the SEC just released guidance this week that really maps cleanly to the spectrum of synthetic exposures versus custodial security entitlements versus issuer sponsored tokens. And each gives investors really different legal standing. The first model is synthetic claims through offshore SPV structures. So you own the shares in the SPV, but importantly, not the underlying securities. So you're a creditor, but not a beneficial owner. And so if the SPV fails, you wait in line with the other creditors. Corporate actions require manual processing. The voting rights, company communications disappear entirely. Execution happens through RFQ systems or AMM pools with what could potentially be wider spreads than NBBO pricing, which is the best price available across all exchanges and that traditional brokers are required to give to you. And so for institutions, a pension fund can't treat an SPV wrapper the same as actual shares for regulatory, capital and compliance. And the SEC's new guidance makes this pretty explicit that, third-party tokenized securities may not confer any rights as a holder of the underlying security, and holders could face bankruptcy risk that direct, shareholders don't. And then I'd point to the second model, which
Wow.
is that of back oh, sorry. I was just gonna say, like, the second model of backed claims through custodian tokenization with proper transfer agent and broker-dealer infrastructure. That's like what Denari is built. That eliminates the SPV layer entirely. And what's really interesting there is that a regulated broker-dealer buys and holds real Apple shares in segregated custody accounts. And like an SEC registered transfer agent issues the blockchain tokens backed one-to-one by those shares. So you own a token representing a direct legal claim on actual Apple shares, not a claim on the SPV, but really on the underlying security itself. And you maintain the full shareholder rights, right? And so that's has a practical advantage of speed and scale because institutions can get compliant access to tokenized equities in a matter of weeks rather than perhaps waiting years for issuers to restructure cap tables. And then the third model I'd point out is where the actual share is through direct issuer tokenization. And this is really a breakthrough model where the company itself issues shares directly on the blockchain. Securitize has talked about doing this, where your token isn't a claim on something else. It's the actual share. It's recorded directly on the company's cap table. And so, when you transfer your token, the registered shareholder of record changes on the company's books, and like the seed and company DTCC structure that I mentioned earlier disappears completely. And so all that's to say, I think this is where tokenization reaches its full potential, where one token equals one registered share. It's transferable peer to peer. You can self-custody your shares with no middlemen hypothecating behind the scenes. Your corporate actions execute automatically through code. Settlement is instant, and intermediaries are actually removed rather than just digitized. And so that's more of like Securitize's approach. But across all these themes, like what good tokenization involves, it's direct legal claims on underlying securities. It's preserved, shareholder rights. It's quality execution through regulated infrastructure. And it's also, eventually the ability to self-custody and use shares as programmable collateral. And so, custodian models deliver the first three at institutional scales. Today, direct issuer tokenization achieves all four by eliminating intermediaries entirely. But, you know, I'd say if you need tokenized Tesla and Apple with full shareholder rights, next month, custodian infrastructure ships that today versus if you're building a platform where equity becomes composable collateral, that's direct issuer tokenization enabling that future and perhaps on a different time frame.
Got it. And so it sounds like at a high level, this is an evolution where ultimately,
Mhm.
we start with the most abstracted and then we further tokenize deeper and deeper into the stack until we're providing everyone these native shares on these companies' cap tables. But there's sort of this design space because different teams move at different paces that a company may want to tokenize now, but they're not ready to take that full leap of faith all the
Mhm.
way to whether it's a technological limitation or it's a regulatory one. They're not ready to go all the way to that end game that you mentioned. It sounds like BitGo has kind of gone all the way, and pushed the bleeding edge as much as possible. But you mentioned Securitize in there. There's other players that are sort of finding a more creative design space and the pros and cons between some of these spaces to try to optimize the frontier of speed and safety and robustness of the product.
Yeah, I mean, I think that summarizes it well. I would just say, put really simply, and I wrote about this, not all tokenized securities are created equal. You have your SPV wrappers that make you a creditor to an offshore entity, custodian models with transfer agent and broker-dealer infrastructure like Denari preserve direct claims and full shareholder rights today. And then, direct issuer tokenization represents, I think, the ultimate architecture with shares issued natively on chain. That's what Securitize is striving for. And where you
Yeah.
land on that spectrum determines whether you're an owner or just another creditor.
Yeah, so basically the shift that's happening in trust, right? I think you've said it's from balance sheets to infrastructure. Basically, as an investor, you need to understand what specifically you are buying based on the infrastructure of that tokenization provider, whether it's Superstate, Ondo, Securitize, et cetera, et cetera, et cetera. Um, with different types of tokenized asset structures. You're basically buying different assets. This is why it's really confusing, Olivia. This is why people don't really understand what's happening
Mhm.
with tokenization. Um, I guess from just a pure investor outlook framework, to summarize what you've said there, from the investor's perspective of wanting to own tokenized assets on chain, could you do your best to provide a simple framework for understanding like the just like the key shift in trust from balance sheets to infrastructure, what that really means, and what we need to know if we own tokenized assets on chain, what to look for?
For sure. And I'd say what this means in practice, again, tokenization shifting trust from balance sheets to infrastructure is that trust becomes verifiable rather than assumed. So instead of, again, from an investor perspective, underwriting a chain of counterparties, investors can verify settlement, custody, and compliance directly on the infrastructure. And so when trust moves to infrastructure, the protocol enforces the rules. So you have settlement finality, asset segregation, compliance gates, all becoming properties of the rail itself that's cryptographically enforced rather than, the covenants that you're hoping someone honors. And so I'd say this is already happening. Like investors are already moving on this. One example is the digital liquidity gateway built by FIS, which obviously is TradFi incumbent, and Intane, which is on Avalanche, and it connects about 2,000 regional and community banks to institutional investors. And so the banks originate, solid small business and CRE paper, but historically institutional buyers couldn't touch it because the due diligence was too manual. Now, loan level data flows straight from FIS core systems onto a chain, and so investors can verify the underlying assets directly. That's like a key example of when trust lives, on chain in the rail. Investors can transact with smaller originators they previously couldn't underwrite efficiently. And so it opens up asset classes that were just simply too expensive to access while also fundamentally changing how, investors think about counterparty risk.
Yeah, I appreciate that. Yeah, I think people are now getting excited about what's happening on Hyperliquid with HIP3, trading a lot of those assets there. There just becomes a stacking of different risks that you need to understand for as you get deeper and deeper into the rabbit hole of using tokenized assets
Mhm.
on chain and then actually putting them into DeFi protocols or trading them on perps, et cetera, et cetera, et cetera. Let's talk about some of the recent news from Avalanche, right? So Robbie mentioned the work with Grove coming up, as well as Galaxy Digital, as well as the ETF VAVX. Talk to us about some of the institutional adoption milestones that you're most excited about, that you've been involved in, what this means. Just kind of give us a bit of the lay of the land of Avalanche's state of affairs, and then kind of what you're looking at ahead into Q2 here.
Off, as you mentioned, ETFs like, VAVX launched this week. We're very excited about that. And I'd say that ETFs like VAVX are essentially on ramps that don't require institutions to overhaul their, operational stack on day one. And so, most institutional allocators can't just add, native AVAX to their books. They need qualified custodians, compliance sign-offs, perhaps prime brokerage agreements to be struck. And that's months of internal work. And then ETF eliminates all of that. It trades through existing broker dealers, settles through DTC, and fits into the standard RAA custody arrangements. And it shows up on client statements like any other equity holding. So very excited that, VanEck's Avalanche ETF can now offer that to investors, launched as a US listed product, providing spot exposure to AVAX. It's also really interesting because the fund tracks, price using a benchmark index, but can also generate additional yield by staking a portion of holdings. So really the strategic function is distribution, and you're creating a point of entry for capital that's already allocated to digital assets, but constrained by operational or perhaps regulatory limitations on direct holding. So very excited about the VAVX launch. I'd point to a couple of other teams that we've seen on your Neo Finance roadmap, which I really appreciate, including Open Trade. They've been doing a great job. Whereas most tokenization projects are, getting execution quality wrong because they're solving the wrong problem. I'm really excited about Open Trade and how, they are letting fintechs offer yield products backed by Franklin Templeton's money market funds or Wisdom Tree private credit, BlackRock's high yield corporate bond ETF, and have created a structure where they've been able to secure 25 plus fintech partnerships in just a year and a half or so across LATAM, Africa, Europe, and Asia. And while most RWA platforms are really grinding to get their 100th retail user, OpenTrade has done a great job of being very distribution focused and taking a B2B2C approach of plugging into distribution channels with millions of existing customers. And they've done a really great job of getting the B2B2C economics down, demonstrating yield transparency to, really accelerate sales velocity, and then also really, starting with securing the right legal infrastructure to, make it really easy for fintechs and investors to get comfortable with their RWA backed yield.
It's awesome. Yeah, I think that's like the next frontier, right? Is actually taking these assets and moving them on chain, and then getting either doing looping, getting additional yield from them, putting them into other DeFi protocols. I'm curious, kind of where you think this all ends here, or
Yeah.
where this is all converging to, right? So you mentioned the neo finance map. We kind of are looking at this as the intersection of legacy finance and DeFi, right? We're seeing this. It's not fintech, it's not DeFi, certainly not traditional or legacy finance. It's almost like this wrapper around DeFi with a really nice front end,
Mhm.
easy to use, forgot password buttons. It's non-custodial in some neobanks. It's custodial in some more fintech apps. A lot of these things are kind of converging towards the super apps. And you're also clearly seeing that a lot of the blockchains are really, really focused on their institutional approach now. Right. And so I'm just curious, like, where you think this converges to, right? Because we're also seeing NYSE move towards 24/7 markets. So a lot of like the traditional markets are also moving towards the crypto infrastructure. It just really continues to feel like these two worlds are like, rather than crypto and blockchain usurping all of finance, it's like we're like mutually colliding, and then we'll kind of see where it goes from there. How do you see this continuing to play out? What's your kind of multi-year neo finance thesis with regards to this convergence of these two industries?
Absolutely. Well, first of all, I'd say that much of the focus in tokenization has been on the supply side. And what we really need to get right as an industry is the demand or distribution side of that equation, like really bringing assets on chain that have true product market fit and demonstrable distribution channels, be it through fintechs, family offices, other allocators. And so when I think, in 2026 and beyond, especially in the context of RWAs and what's underexplored, when people talk about RWAs coming on chain, the conversation usually starts with inventory. It's about treasuries, private credit, real estate. And you could argue, certain tokenized assets are poised to catch a tailwind this year, depending on your macro view, as a Fed balance sheet expansion and rate cuts, could unleash like a fresh wave of liquidity. Maybe it's LATAM sovereign debt or liquidity sensitive plays like uranium funds that are tokenized that'll really, gain traction. But I'd say that supply side focus and framing really misses where the real change is happening. And I'd say the most underexplored RWA category is not so much an asset class, but more so in the structure. And what I mean by that is it's vaults, the infrastructure that lets you, express investment strategy directly in code with custody that never leaves the investor's hands. And it's really about providing, investors and specifically institutions with greater utility. And so, traditional asset management at this point is duct taped together, like strategies are buried inside legal vehicles, assets are shuttled between custodians, administrators are scrambling to reconcile after the fact, and liquidity is rationed out on a schedule. And even the best designed products end up sluggish, overpriced, and opaque. And if we can find a way for tokenization and RWAs to address those pain points and really incentivize institutions to go on chain simply because it's better, faster, cheaper, then we've achieved our North Star vision. And I'd say one example of that, where tokenization is providing more utility and would incentivize institutions to come on chain is with vaults, which are rules based, portfolio, runs directly in software. Investors can unlock, and retain full control of their assets while, allocation, utilization, and risk limits, all execute in a single settlement environment. That's the sweet spot between an ETF and an SMA, and the scale and accessibility of the one, the precision and the guardrails of the other, where, you're never handing custody to a manager. That's quite compelling for institutions and investors. And we've seen Bitwise made a move into vault curation this week, and I think that's a signal worth watching. And their $15 billion asset
I did
manager,
see that.
yeah, they didn't just roll out another tokenized fund. They started writing portfolio construction directly into code. And it's just been more specifically a stable coin lending strategy on Morpho. I think it's targeting
Morpho,
about
yeah.
6% yield. And Bitwise is setting the parameters, the smart contracts enforcing them. And critically, the manager never lays a finger on client assets. And so
Yep.
the business case, again, is really concrete. There's utility. Vault's got the cost stack. There's no custody fees. There's no fund admin. There are no armies reconciling spreadsheets. And so
Yep.
new strategies can spin up without forming new legal entities. That shrinks launch timelines from quarters to weeks. And, the accountability really flips from you can trust us to transparent real-time parameters that anyone can verify. And I'm really excited for this model to gain traction. I think that'll bring a lot more institutional participation. Bitwise predicted that their vault AUM may double in 2026. And if they're right, one of the more value RWAs on chain may turn out to be, institutional judgment that's spelled out clearly on chain and enforced by code.
Yeah, and non-custodial, and gets the best of DeFi in a rate cutting environment, still gets good yield. People who are new to crypto or DeFi will see that from Bitwise, and they will be very curious if their average Robinhood Gold account is giving them 4%, 3.5%.
Right.
Their money market on Schwab is at 3.7, 3.6. All of a sudden Bitwise has a 6% product. They'd probably be a little bit concerned as to what the risks are. And lo and behold, there is quite a bit of smart contract risk, DeFi risk, etc. But yeah, that is a vaults. Olivia, we'll have to do a whole episode on vaults. I think there's a lot for us to learn.
Also, I feel like I need to say, not financial advice. Do your own research. Give all the disclosures. Should have started with that.
Well, naturally, yeah. But this was all tremendous information. I feel like, we got our daily dose of financial education here, whereas a lot of times we're talking about, the more digital asset, crypto side of the world. But a place where these two are going to converge. Andy and I both, I think, are planning on going to Vault Summit. It's in Cannes, so it's around ECC, but it should have a nice mix, and it's presented by Morpho. So I'm looking forward to that event. But there's a number of events this year that should be quite good as more of these worlds start to intermingle together. It should provide a nice balance.
Yeah, for sure.
All right, Olivia. Well, we'll see you soon. Thanks so much for coming on. It's been an absolute pleasure. Like Rob said, learned quite a bit here. You're a great speaker.
Thank you. Really appreciate you guys having me on.
We'll see you again soon. Thanks, Olivia.
Bye.
Bye, Olivia. Peace. All righty, guys. Up next, we've got our next guest. We've got Gracie Chen, the CEO of Bitget, who is going to be asked what she thinks about Hyperliquid for a long time.
Olivia was great, man.
Olivia is bullish on uranium.
That was hilarious. I wonder if she heard us talking about that beforehand, or if that was organic. But man, I think there's a lot going on in this traditional financial space, and we're so entrenched in the deep.
Yeah, we have no idea what's
crypto.
going on.
I mean, what happened was
so much to learn, man.
We went exactly right. So we we were obviously
for some of
much more hands-on in DeFi, and now and then right, if we're just going back into the Rollup lore, we had to sit down for 90-minute conversations with CTOs to understand the blockchain architecture.
I know.
Our next 3 months are going to look like deep conversations,
finance architecture
with
tokenization, and the lingo too. It's the whole lingo is SPVs and
SMAs and ETFs. You gotta have your 3-letter acronyms in order to speak the language. And so we've got Gracie coming up next, CEO of Bitget. I don't know if Gracie even knows this, but Bitget was our live stream sponsor at DevConnect down in Buenos Aires, and it was phenomenal. I mean, we were in the war room. We pulled it off. Supposed to be at the main event, And then we had to switch locations. There ended up being no Wi-Fi at the main
Yep.
event. Pivoted, ended up getting a great space to record the show. Shout out to our friends over at Lambda Class, locals
I
there
still can't
in
believe I
Buenos
jumped out of
Aires.
a plane yesterday.
That
Anyway, let's
is
get
quite the
Gracie on.
story. And yeah, let's bring
We'll
Gracie
talk
up.
about that after the show ends. Gracie, how are you? Welcome to the show.
Thank you for having me. Yes, it's great. I also just landed in the US from yesterday, so now a
Oh,
little bit jet
beautiful.
lagging, but having a great time.
Well, welcome. I'm in Hawaii. I jumped out of a plane yesterday, and I
Wow.
survived. And it looks like the markets followed me today. Kind of saw that one coming. Gracie, we're gonna get into it. It's gonna be spicy. Feel free to say no comment if you don't want to comment. But everyone is blaming CZ and Binance right now. Binance just unloaded a massive clip on the market of spot Bitcoin. You can literally see it in the flows. Every time Bitcoin dumps, Binance is unloading clips of Bitcoin. People are really pissed about CZ, that they think that Binance is corrupting a lot of the market and that this market can't continue in a healthy way with them as the number one exchange. What's your take on the current market structure here with Binance leading the way in terms of their selling of Bitcoin? Where are you kind of looking at the broader crypto market structure as it lands today, post 1010? I think a lot of people are upset. Gracie, we brought you on to get your market takes. Thanks so much.
Sure. Well, 1010, I would say yes. It started with a Binance technical slip, like a glitch, and then it followed with USD ED pegging on Binance, a few of other wrapped coins in BTC and Ethereum. Also, due to the kind of death spiral effect, went down a lot. And then largest liquidation, daily liquidation happened on October 11th or 10th, depends on your time zone. I was also traveling at that time, and when I saw that happened, it's just massive. Lots of I think that time Asia wasn't awake, but that time I was in Dubai translating, and I get to experience the whole thing more vividly. What I would say is after October 10th liquidation, the market, especially the altcoin market, is very, very weak in terms of liquidity, in terms of trading volume, or just interest. Well, people were talking about altcoin season, but even in early 2025, I've already said I don't think there will be an altcoin season at all. But liquidity on the largest liquidity crash on October 10th just made it more true and more magnified. So right now the market is still, in my opinion, kind of correcting and finding its balance. Later this year, I do think Bitcoin has still very strong fundamental because of the larger liquidity coming out of the market in 2025. They flow into gold and even U.S. stocks like Nvidia. These assets all hit their all-time high, but Bitcoin just fell from world's top 5 asset class to right now top 8 or 9. I think Bitcoin is actually the best asset to reflect liquidity because of the fact that it doesn't really have a pricing model. So the price can be largely adjusted or affected by should be a good reflection of liquidity. In 2025, we didn't see it happen because that year gold went up 60%, but Bitcoin went down 6%. Right now, today, like you pointed out, gold, silver went down, US stocks corrected, Bitcoin and all the altcoins also went down. But I actually think it's a little bit panic due to the geopolitical reason, or maybe some exchanges are selling. We are not. Actually, for the past 11 to 12 months, we have been actually accumulating Bitcoin rather than selling. But my point is, in general, my market take is this year shouldn't be too bad. Should be, Bitcoin still has a chance to hit 150K or so.
Love it. Yeah, I think we had Hasib on for our 2026 crypto predictions. He thought the same with regards to ending this year. One of the recent things that is happening as a result of this liquidity shift that you talk about with regards to metals, US stocks, and others is people wanting to trade these assets in crypto rails. So whether it's on chain or on centralized exchanges, people are now wanting to trade stocks. They want to trade gold. They want to trade silver, copper. They want to trade all these assets on chain. And the place dominating that is Hyperliquid. Hyperliquid's HIP3 has allowed them to basically create a way that they can trade pretty much any asset on chain on Hyperliquid. The daily volume has hit 2 billion as of today. The OI is almost at 1 billion, and they're growing 100% week over week over the last couple of weeks. This is like the biggest growth story right now in crypto. We think uncorrelated in terms of the rest of the market. How do you think about the rise of stocks, gold, metals trading on chain as well as on centralized exchanges? Is this a priority for Bitget? Do you see Hyperliquid as a big competitor, or do you see it as good for the ecosystem? How do you kind of think about this entire new market of crypto traders and retail wanting to speculate on other asset classes, but do it on chain or in the crypto native friendly platforms that they're used to?
Uh, you may not realize we actually offer on-chain asset trading as well
Yeah.
as tokenized US stocks, tokenized ETFs, etc. Actually, Bitget from September 2025, we call ourselves UEX, Universal Exchange, rather than CEX or DEX, because people used to think, CEX, DEX, they are very different. CEX are very centralized, DEX are not, and then KYC, like AML standard, everything is different for CX and DX. For us, we are still holding a pretty high, at least from a KYC AML point of view, in terms of having all our users needs to do KYC. That's more like CX. But in terms of the asset offerings, we are you can call us DX. That's why we think, none of these two words can define us well enough. And we said UEX. UEX is a little bit similar to what Brian Armstrong called it everything exchange. Now we often offer tokenized assets on chain. Any of the assets that's issued on 5 top public chains, including Solana, Ethereum, BSC, Monad, Morph, are all tokenized, are all tradable on Bitget. You can just put your contract address and then trade. And then tokenized US stocks is another big market that we're developing. So back to your question, I feel Hyperliquid is, I wouldn't call them a competitor because essentially the market that they are serving is a bit similar to what we were before being more compliant. There are users that we gave up when we said we need all of our users to do KYC. So they moved more, some of them moved to perp DAX or DAX in general. And we, as one of the largest centralized exchanges or universal exchanges, we do need to be more compliant. Otherwise, we can't go bigger. So that's a little bit of a give and take kind of game in terms of who we are serving, what we are offering. But in general, I see lots of potential in TradFi, in tokenized gold, silver, stocks, etc. And we see lots of tractions over there since the last few months when we launched tokenized US stocks and silver, gold, etc. So through some CFD platform.
Yeah. So is that how you see the perps market and the trading market like playing out? Like you get this kind of bifurcation of the more, let's say, not compliant, borderline gray area exchanges or on-chain venues that don't require KYC, AML, et cetera. And then you'll have like the much more compliant, institutionally oriented exchanges that have all of the checks and balances in place. And you'll kind of see this split happening. And if you're kind of in the middle, you're kind of left in the middle without an edge. Is that how you think about the trading landscape evolving in crypto generally?
I think so. I think that's a good summary of how we look at the market. Actually, last year we spent a lot of time strategizing and thinking about which way we should go. whether we want to go for more compliant, more mainstream market, or continue in running an offshore exchange and in the gray area. So we chose the first way. And it doesn't mean that the second path wouldn't be successful or wouldn't have a market. Actually, there's a big market because we've been there in the sense that that we know the market is very big. And going the first path is probably the tougher but more correct choice for us.
Yeah. How do you see the space trajectory with respect to the assets that are coming on chain? It's no longer just Bitcoin and Ethereum. On the show, we've said that there's sort of a lack of quality assets. But you mentioned like now we have, tokenized commodities, we have tokenized metals, and there's a growing asset class in income products, which is effectively like these tokenized money markets, tokenized private credit, all these tokenized RWA products. Typically what we've seen in terms of these income style products is, it starts with a stable coin that you own in your wallet, at least if it's on chain. You go take that stable coin and deposit it into some sort of yield producing vault or smart contract. Now those things are getting packaged up and distributed just like regular assets that pay some sort of yield or dividend. Do you see Bitget as sort of a distribution pathway for a lot of these assets right along with the speculative assets? Or generally, how do you see, serving the golds, the Bitcoins, the fixed income assets, the, tokenized RWAs, serving all of these products when all of them are so different without overwhelming the end users, right? Still providing a simple user experience.
How do we make sure that we don't overwhelm users? I think that's a good question. I sometimes find it confusing, and I talk to my, for example, CPO, chief product officer. It's a she as well. So two girls having lots of conversation about what market is feedback is giving us feedback, and how can we improve from the product wise. So a few thoughts around that is, first of all, I probably don't have like a full answer, and I think we are overwhelming our users a little bit by providing universal asset coverages.
It's the balance, right? It's like users always want more, like they want more choices, but they also want it to be simple. You just can't have both simplicity and lots of user choice.
Yeah, that's right. But the big picture we are seeing here is not about how many tokens we have or how many assets we provide in terms of trading. It's about what users want. So even for tokenized US stocks or ETFs, we are not listing all of them. We only have about 200 tokenized US stocks. And then for the futures trading, the perpetuals of those US stocks, there are only 30 plus. On the other hand, crypto and altcoins, I would say in 2025, we did slow down a lot on token listing for the pure crypto native kind of token. And we delisted a lot that were on us. The reason being these asset classes or these altcoins we are not seeing as much liquidity trading volume. Sometimes price can just crash like 30% a day. And those assets are not traded by the users anymore. So we delisted them. So while adding all sort of asset classes on Bitget, we are also delisting some altcoins. So the major shift that you are seeing here is less and less crypto native, especially those altcoins that's not providing or producing real value. More and more mainstream asset. They are listed on NASDAQ and NYSE, big ETFs and indices. They have much more fundamental value. So as an exchange, we want to look at, number one, what our users want. Number two, what are the assets that has value, that has volume, that has people who want to trade? And then how do we enable them? So that's the methodology behind. We definitely don't want to overwhelm our users, but as far as we keep this mental, mentality here that we know what we're doing and why we're doing them. I think that should be fine.
Yeah. Gracie, the users want to trade uranium and they want it now. They want to trade commodities right now. They
Don't
want to
let
trade.
Andy sell you uranium. Andy's got a big uranium position he's been pushing on this show.
That's
Well,
funny.
it's
You
one
know
of the
what's funny is
tokenized
that
metals.
the
Go ahead.
Tezos guy came on, Rob, so long ago and told us about it. Remember that? And
Yeah, he did.
and it was
They had
way
a
lower
tokenized
than.
they had a tokenized uranium product that they
Yeah.
listed as well, right?
Yeah, Gracie, I'm curious, when you're thinking about the current market structure, I just want to come back to 1010 because I saw this tweet today that was like, oh, 1010 really screwed us, and it was the chart of Bitcoin negative 15% since like June or something of last year, and then it was S&P, Nasdaq, gold, and there was like 22%, 22%, 40%. Like, do you think we're still picking up the scraps of 1010 in the market? Like, do you think that we're still like navigating market maker fallout? We're still waiting on some like pieces to get put back together? Or is this just like we all, said this time was different, that the 4-year cycle was over, but it's a midterm year. It's the year after, or it's the the 4th year of the cycle has passed. Bitcoin had an 8x from 15K to 125K. We're just going through the usual pullback here, and 1010 maybe could get blamed for it, but hasn't left necessarily like catastrophic damage in terms of the structure. Like, I'm trying to get a bit of insight from your side into the structure of what you're seeing. How healthy is the structure right now in Bitcoin? Do we have cause for concern with regards to the way that market makers, exchanges, et cetera, are holding up? I mean, we had a crazy 2025, right? With Bybit. I remember you coming out and helping Bybit with their hack, and then 1010, and then all these things. And so, like, are we at a healthy point behind the scenes right now? I'm not sure exactly what you can share, but I'm just curious, like, what you're seeing.
That's a good question, and I don't have a crystal ball. I wish I could. But telling whether this is already very healthy position or not, that's like holding a crystal ball. But I do think fundamentally, Bitcoin, as we pointed out, Bitcoin should still have a rally because of the liquidity is increasing. The global market, monetary supply is increasing, and Bitcoin should reflect that. Um, whether the well, I also noticed that maybe yesterday Kathy Wood thought that the so-called correction period should be very much finishing now. I'm slightly less optimistic, but I'm not pessimistic. What I mean by that is I think I don't want to really guess the market. But if you're a long-term holder, what you should do now is probably accumulate a little bit of Bitcoin, especially if you don't have any position.
Mhm.
But whether Bitcoin can reach another 70K, even 69K, I think it is possible.
Mhm.
I as a long-term holder, I'm more like I prefer to start buy when I see the trend being very obvious. I don't mind buying slightly higher, but I don't want to be very very much like, again, predicting or just speculating on what's happening in the
Yeah.
market.
Yeah.
Well,
If that makes sense.
it does. It does. And I think, because you don't have a crystal ball, none of us do. We're just, we're trying to draw, what a unique perspective that you have as a centralized or, a universal exchange, as you called it. You've got quite a bit of insight into the flows, right, of several high volume market makers and traders. And so I guess I'll just double down, not trying to ask you to predict, but a very similar question is, are you seeing anything in the flows as far as, is it more retail? Is it more institutional? Is it, a greater volume? Is there anything that you can point to in how you're seeing the trading via Bitget, right? All the throughput that is coming in, the volume that's coming in. Is it on particular assets, more on maybe the major asset classes, or less on altcoins? Is there anything that you can point to in the trading flows through Bitget that are signaling anything to you about the market?
Mm. In terms of what we see,
Mhm.
running the business was I would say institution and retail are like half in terms of volume. But the asset classes that they prefer is very obviously mainstream cryptocurrencies. And also the mainstream US stocks are picking up in terms of volume on Bitget as well. TradFi, gold, silver, copper, etc. Even Forex. We also started to offer Forex very recently in January this year. So the conclusion from that observation, or my personal take, would be Bitcoin is still dominating the narrative, and especially if you are running or planning to do a token launch on altcoins, you want to make sure that your project can hold in the long time and is doing your business, have some sort of inflow, rather than purely issue a token then rug and
Yeah.
leave.
We
That would
call
be
this the
very
revenue meta, Gracie.
yeah, that would be very bad to the
Yeah.
market, and that won't succeed either. Right now, exchanges are very, very selective in terms of what token we are launching.
Yeah, just last thing there, Gracie. What has been the major changes for listings and for tokens, right? Because we've got this general thesis that, and I think that the entire market knows that it's changed. It's gotten more harder due to more tokens, more dynamic, different types of businesses. Give us the quick and dirty here on the changes in what you're seeing industry-wide on token listings and on the way that exchanges are operating with new founders, kind of trying to prevent these slow rugs or easy money operations that have been plaguing the industry for a while. What are you guys changing, and what are you seeing as the core industry-wide shifts here?
The core industry-wide shifts would be, again, pure crypto native stories won't really work. Some of the good projects that we see now are either infrastructure like RWA, stablecoin, PayFi, and then probably have some sort of elements in AI. So this is not just how exchanges are listing. I've talked to a lot of VCs, VC partners as well, and I think from the VC point of view, what they are investing is also shifting a lot. We actually collaborate. We already funded a VC 400 mil AUM VC called Foresight Ventures, and we do have like weekly meetings. It's the same thing. So the narrative has been very different. And then from an exchange listing process point of view, not sure how much you know about how we evaluate project, but I can give you some sort of quick summary.
Please.
Would be we do look at their product. Like if you have an app, you have an agent, we want to look at what it is doing exactly. We also want to look at the community and social, so that we know how popular this project is. And we even divide the volumes from geographic point of view in order to understand how healthy those volumes is. And then token economy, that's just another big monster there that we have some core team who will look into them. And we want to ask for auditing report for some token auditing as well as code auditing. We look at the background of the project as well as the background of the investors. So it's a quite tedious process that our listing team is like the BD talking to the project, but behind them there's a very strong research team who look at each elements differently and support our listing managers to talk to the project and come up with good plans. Yet I would say in 2025, most of the tokens, especially after October 10th, are kind of like the graph probably look like this. Like the listing day is the highest price for them, which is again very unhealthy for a whole sector, for the whole blockchain or crypto sector. People said Web3 is dead. This term just doesn't make sense. It's not revolutionizing Web2, at least from the application point of view. I probably agree with that, and that's why we have not been listing as many altcoin tokens. And I even tweeted, I said altcoins are dead.
Yeah, I saw
although a little
that.
bit extreme, but I want to make my point in that sense.
Yeah. Gracie Chen, thank you so much for your time. Enjoy your time in the US. Enjoy your time fighting the good fight here. Thank you for your energy and your work in the industry. And we'll have you on soon again. Thank you so much.
Thank you.
See you next time,
Thanks.
Gracie. Thanks.
All right. The uranium market's closed, but we're up, boys. We're up. We're so up. I'm on. I mean, I don't know what to tell you guys. I thought I loved crypto, but then I realized I just like seeing my portfolio go up.
So how much has uranium gone up relative to gold? Like the run up in gold has been, I mean.
So the run up in gold is
weekly-
separate from the run up in uranium because gold is not a precious metal, or sorry, uranium is not a precious metal. There's a massive uranium shortage right now because, so basically like in that book, The Rise of America, the guy Marin Katusa talked all about basically the rise of America. It's the name of the book. And like, it wasn't, you brought it up on the stream yesterday, I think, or the day before with one of the guests where you're talking about, we had this globalization, then we had like this nationalization. Now it's like localization. Basically what's happening right now is the reindustrialization of America. Yeah. And so due to the reindustrialization of America, there's a set of resources that need to get
I see.
Towards.
So uranium's not a precious metal, but you'd consider it like a rare earth?
It's kind of in the middle between a precious metal and a rare earth. It's almost like a utility resource. It's like a utility metal.
Is this what goes into uranium is what goes into nuclear reactors?
Yes, and the thesis is that we need so much power, and the taboo against nuclear is gone. There's a lot more positive developments in the nuclear space. And basically there's a shortage of uranium. And it's been under allocated to compared to like the stocks, etc. for a while. And I don't know, man. I've got a massive bag of uranium, and so I'm here. The chart looks insane. The weekly and monthly look insane. Crypto's fucked. Like I'm just like, I don't really care. I mean, like I have my Bitcoin, I have my ETH, I'm holding, I'll hold forever. I'm glad to have it, but I'm not gonna sit here and watch crypto bleed out and just act like I am so loyal to the coins when at the end of the day, it's like, dude, there's other markets that are chatting and like, I don't know, man. It's just, why am I gonna, I redid my plan. I'm ready to go, Rob. Let's fucking go, uranium. 10-year cup and handle. 10 year.
I mean,
10 year.
That's kind of what gold went through as well.
10-year cup and handle on the Sprott Physical Trust breaking out right now. Literally the most insane. Here, I'll send you the chart in the chat real quick. You can have a look at it. Unreal. And then we can go through some of the news and stuff, but 10-year cup and handle on that thing. I mean, come on. Come on.
And it looks good. Were you
that
here?
Gotta go.
Were you
that
in?
Gotta go.
So from 2020 to 2024, almost exactly 4 years.
Dude, when I got the book from Mr. G, my mentor,
it was 2020.
Literally 2020 at the bottom, the Pico bottom.
God. Oh my God, that was the Pico bottom. That was the perfect entry back in, that would have been January 2020.
Yeah,
and
my first entry was like, I don't know,
a monthly chart.
Yeah, my first entry was like 4 to 6 weeks ago.
Yeah. Okay, so it was still, it would have been like 2025.
Yeah,
late
I mean,
2025.
No, yeah, like
so
sometime early this year, late last year.
4x from the Pico bottom to the top of the top of the range.
And the thing is, it's still not even allocated.
Isn't it kind of crazy how, again, like I am not a technical analysis guy. That is very much more your world, but you got to think like this is really clean. Like it did like exactly a 4x in exactly 4 years. And then it retraced from pretty much exactly 30 to exactly 20.
Dude, I'm so in, man. And this is going to take 6 months to break out. And then crypto's going to, I don't know. Gracie was actually on what I think is the right train of thought. I think Kathy Wood's too bullish. I think these other people are too bullish. I think Gracie's thinking about it right with Chris and Ben, which is be accumulating this year. Don't be expecting any crazy optimistic turnaround anytime in the immediate term. But be accumulating, I think, end of the year at 150. Like, if I could hammer uranium for 3 to 6 months, take a lot of that, if I'm right, and put it back into Bitcoin around 60 to 80K, oh my God, that would be sick. Like, that's my plan. That's my current plan.
I think it does
God
make
knows
more
where
sense. I mean, I have a comment and then a question. Comment is I think that it does make more sense to pricing Bitcoin in dollars is cooked when it's debasing. It's going to give you the wrong sense of the equation. Pricing Bitcoin in gold, Bitcoin in silver, Bitcoin in copper, Bitcoin in uranium makes a lot more sense because these are all things that have their own, like, you want to price on a relative basis, right? And so it's not like you want to own dollars, you want to own hard assets. So it makes sense to price hard assets against hard assets. So you have a fundamental thesis on uranium, right? I understand how the repatriation of industry in America makes sense. This is going to be very bullish because there's going to be a shortage. Ukraine and China don't want to give up their rare earths. They would,
there is structural supply deficit forecasted out to 2045. The spot price has risen 5x in 6 years, and absolutely no new greenfield uranium supply has entered the market.
Right. Okay.
Like basically what needs to happen is there needs to be more nuclear power plants created to effectively mine more uranium to lower the price of the nuclear energy. Is like kind of how I understand it. Right now there's not that many new plans to create new nuclear energy power plants.
Right. There was a comment on All In the other day. Chamath and David were talking about nuclear and how David was the typical energy guy, is very bullish nuclear. Chamath was a little bit against nuclear. He picked copper as like a much better bet. Or excuse me, they weren't talking about uranium, they're talking about nuclear, but nuclear is a very fundamental part of the thesis here. I know you want to show. Okay, wow. Well, if we're moving off of uranium, we're talking.
No. I was going to show this uranium chart.
Yeah. Well, we need another minute to bring it up here behind the scenes. So I wanted to ask you, right? There's a fundamental thesis here around uranium. I think it makes complete sense. There's a supply shortage. There's repatriation of industry. They need more of this in order to build out power. All of this is all confluence, right? That leads to it. What is the fundamental thesis around why Bitcoin goes down? Is it that
Dude, the chart is cooked?
Okay.
There's
I don't
Sailor's going to sell.
I don't care about the chart.
The chart is cooked.
I don't care about the chart, dude.
There's all these whales, sellers. There's no net buyers. Everyone's buying gold instead. All these other markets are pushing forward. There's outperformance everywhere else that you look, and as the outperformance continues, you just get people leaving Bitcoin and selling it. It's already up 8x from the bottom, from 12K, 14K to 125K. It's the 4-year cycle. It's the midterm year. 1010 destroyed the entire market. Sailors buys have gotten way less. MicroStrategy's cooked way under MNAV. DAT's failed. Dude, this market structure is cooked. It's cooked. It's so cooked. You're like, oh, it's in chop, man. And I've been screaming from the hills the last 3 months. This ain't chop. This is bear market.
I mean, if you look at the last 2 months of price action, we've been in a range between 80K and 95K. And now 2,800.
Say bye-bye to your range, buddy, because
2,800 and 3,200. Say goodbye to the range.
Say goodbye to the range,
I'm not gonna expose your top blasts.
Say goodbye. Look, I top blasted ETH 3,300. That range is cooked too. That thing's gonna bleed. Bitcoin and ETH are both leaving their ranges to the downside. It looks like almost, I would say certainly. I would say highly likely.
They're at the support of they're at the lower bound of the range right now. So, it's easy to say that when something is tapping against the floor, right? If it's tapping against the resistance, it's easy to say, yeah, it's going to break out because it's a much smaller move.
What is the reason why
break through?
Why is Bitcoin going to go up? What is the fundamental reason for a bid here?
Look
Or
at the
ETH?
SEC, CFTC is meeting to discuss crypto regulation. We have America is becoming the crypto capital of the world. Trump has his finger on the Fed retire button, which is also the same as the money printer button. They're cutting rates. We know they're cutting rates. Jerome Powell's a cuck. He's not going to be in the Fed anymore. We know there's going to be an increase in liquidity. The New York Fed is going to intervene in the yen. They're going to print money. They're going to bail out all of these sovereign nations. They need to find net new buyers of treasuries. Those are stable coins. Stable coins are going to pour money into Bitcoin. All of these crypto companies around Bitcoin are going public, getting acquired, raising more money. These are all raising. It's not the crypto infrastructure slop. It's the neo finance public Goliaths that are winning. And the thesis that all of that in surrounding infrastructure, Bitcoin and ETH are the core assets to which people can get exposure to the private companies around those core theses. That's
Chat
the idea.
says if crypto is now desperate for regulations in order to pump, then we failed as an industry. I agree, chat. I think Robbie's thesis is grounded in fact and in objective truth. However, it is grounded in the lack of understanding that these small regulatory changes, they impact the narrative over the long term, but have very little effect in the short to midterm, like 2026. Like if Clarity Act goes through this year, doesn't really matter, doesn't really affect the market in 2026, in my opinion. I mean, maybe it provides a nice bump, but like that's more of like a 5-year thing. Rates, yeah, the rates cutting could work, but like
it's the increase in liquidity, man. It's the same
yes,
debasement
that is
trade.
the only reason.
The same debasement trade that's leading to gold has extraneous factors as far as the US dollar becoming less of a reserve currency as to why that's going up. Central banks are accumulating it. Bitcoin is a better measure of global liquidity because there's not
I'll see you at
new
72K.
mines. I think if you look,
it doesn't matter. It's going down there and then it's going to go higher. I think that's the reality.
The most bullish.
We're going to get to the 60s to 70 range, probably, maybe, definitely 70s. 60s would be crazy, but possible, right? That 72K range looks great. We'll probably chill there for a little while and then we'll rip.
I guess problem, benefit, it depends on how you look at it, but that doesn't seem so far away.
No, it doesn't.
Obviously,
but,
if you can,
but if uranium rips in that time frame,
right?
that
Exactly.
sounds
If you can make more money elsewhere,
I'm not taking that downfall. I'm not taking a 25%. I'm not taking 25% more downside on the chin here. Fuck that.
From
85 to 70
80,
is like.
I mean, now we're not 85. Now we're closer to 80 than we are to 85.
We're at 84.3. From 84 to 70 is 20%. Plus a wick down to 68, 67. You're looking at 25%. Dude, that is a lot of money for my size. Sorry, man. I know that you're I know that you're trading nickels and dimes.
You're hilarious, dude.
I'm not fucking around.
You're hilarious. No one
you
wants
can't
to
go
take
higher.
No one wants to take a
sailor goes belly up.
No one wants to take a 20% drawdown.
All right, let's get the uranium on the chart here. Let's have a look at what's going on here.
Let's bring it up. I don't think we get to 60s. I think we get to 70s, maybe.
Sprott Physical Uranium Trust is going to go parabolic. The market is tight. Spot is raising cash every day, and the structural supply deficit is forecast all the way out to 2025. Guys, remember on my book, The Rise of America, Marin Katusa, we talk about how there is less nuclear power plant plans being built than before, while the demand is simply going to grow, meaning that there will be a premium on the price of uranium. Sprott price has risen 5x in 6 years and has absolutely no greenfield uranium supply has entered the market. We've only had old mothballed restarts. We scroll down a little bit. If a 5x increase in price is not enough to incentivize new supply, we can only assume prices go significantly higher. Don't fade uranium in 2026. And if you scroll to the bottom here, you see that our boy Blunts has a pretty good chart. And I mean, uranium looks ready to go. I mean, look at this thing. So this is my biggest position in all markets right now. And I'm in with you, Blunts. I've been in for a little while. I should have got in when I was in 2020 reading the Rise of America book. I have a fundamental thesis here. My only concern is that it's just going to track gold, and gold doesn't look that great, but hopefully it can just kind of stay sideways and cruise for a bit instead of just dumping or just keep going higher. So guys, I mean, look, I'm in uranium. It's my biggest position in the entire market right now. I've got a substantial amount of my net worth in it. I'm looking for a nice 3 to 6 month move. I don't know when the crypto rotation is going to happen. I'm not planning on waiting on it. I think everyone else is there with me as well. People are tired of waiting. Rob's going to wait though. We'll let Rob wait. And yeah, I mean that's uranium, guys. I'm bullish, so I'm in. We'll see what happens. What do you say we cover some news, hey, bud?
Let's do it. I'll send you this all in clip later.
Yeah, I mean, Chamath is bullish on
Chamath is bullish
copper?
on copper. David's bullish on nuclear, but
Copper's
Chamath
just hard, man. I don't know.
Chamath is bearish on nuclear as the solution to America's power deficit.
Right, but like what Chamath thinks doesn't affect the market.
So our first bit of news here is that
Chamath. Chamath
Mesh-
is FOMOing people into copper. Come on now, Chamath. Get out of here, bud.
Let's we're gonna get this up in just a moment. As we wait here, just look at this beautiful drawing. Look at that technical analysis.
Dude, copper.
I don't know if you guys.
Dude, I mean, uranium's ready to go, man.
All right,
It's so ready to go.
let's blitz through these news headlines because we've got quite a bit.
Okay, let's go.
We're gonna be up here in a moment. Why don't you just continue to shill us your rare metal thesis while I look for this clip?
I am going to let you find that clip and cover some news. And yeah. Man, what a day in the markets here. All right, Mesh Connect secures a pretty big stack of cheese. $1 billion valuation after a recent $75 million funding round. And yeah. Are you still looking for that clip?
Yeah, give me a sec.
Nice. All right, let's just take a quick break here, and we'll be right back covering some of these, all of the news. Take a quick standby, quick commercial break. Thanks, guys.
Yeet is built for big moments. The most fun you'll ever have with your crypto. Go to yeet.com to yeet into your next game.
Not your keys, not your coins. From the team that pioneered cold storage, Trezor has just released its new wallet. Guys, if you are still using hot wallets in 2025, 2026, you are missing the entire point. Secure your coins. Get a Trezor at trezor.io.
Go anywhere on-chain instantly with Relay.link. Relay is closing in on $10 billion transferred. Go to Relay.link to bridge your assets now.
Money shouldn't wait for Mondays. Following its real upgrade, Polygon is now one of the fastest chains for stablecoin transfers and payments. Visit Polygon Technology to learn more.
Kalshi is the world's largest prediction market. You can trade on anything in all 50 states. Go to kalshi.com to trade today.
Talk to AI like your lawyer or your doctor or your therapist. Yours, private, and here today. Visit near.ai to have a fully private chat experience.
Havachi is fast and private perps trading, secured by ZK with Celestia underneath. Go to hibachi.xyz to start trading today.
Looking for yield that stands out? Infinify gives you just that. Deposit stablecoins and earn far more than the current savings rate. Infinify is a battle-tested, reliable DeFi platform that is ready to go. Head to infinify.xyz.
Halliday is unified crypto payments. Give your users more wherever they are. Go to halliday.xyz to never write a smart contract again.
Open, stable, borderless. Frax is building the next generation of stablecoin infrastructure for the digital finance era. Visit frax.com to learn more today.
Yeet is built for big moments. The most fun you'll ever have with your crypto. Go to yeet.com to yeet into your next game.
Not your keys, not your coins. From the team that pioneered cold.
All right. Let's see the uranium clip. What are we seeing here?
I'm gonna play it. Let me know if the audio is good, okay?
You're gonna play it.
Build out. I think you get some credit there too, yeah?
How's this sound?
Yeah, that's fine.
Not sure. We got some work to do there. Massively,
we definitely saw
massively short nuclear.
You're still short nuclear, but I know
It's
my
above
guy
this.
Howard Lutnick,
It's a
when I
big
talked to
zero.
him, I talked to Howard Lutnick as well. He said he's all in on nuclear.
Freebird, can I tell you why I'm short
Yeah.
nuclear? I think
Yeah.
that we're in the very delicate part of the cycle where they've missed the window. So by the time that they deliver working SMRs at scale, the problem is that the marginal cost of electricity will effectively be zero, and it'll have gone to zero because of a combination of solar and storage, as well as coal and oil. And so it's just in a very delicate place where the large form factor nuclear reactors make zero economic sense by 2032 or 2035, which is when, through the Byzantine permitting and building, they get it done. And then the SMRs, by the time that they get it done, they may not be able to meet the market either. So I think it's a very complicated moment for nuclear, actually. Not scientifically, economically, just does not hang together mathematically.
I think that's if you assume no shift in the demand curve. And I think that, like, if you look at China going to 8 terawatts of production and by 2040 or whatever it is, and we're sitting at 1 and we're not moving, we are going to have a big catch up to do. And the question is, can we really build out 2-3 terawatts of electricity generation? How are we going to build out 2 to 3 terawatts of electricity generation? The amount of land that you would need with solar, and what's it going to take to get all of that installed and so on. And by the way, there's a lot of this stuff in China. If you look at all the big solar build outs that they did where they're ripping it up now, this is a longer conversation, but I really do question whether we can pin everything on solar. It's going to be a mix of stuff. And so your point may be right that in the near term, to meet the current kind of demand curve, nuclear is going to be economically challenged. But at some point here, there's an inflection that we have to meet. So what's your most anticipated trend?
So you got both sides of the argument there.
That we're gonna have the marginal cost of electricity is gonna be at zero because of solar and storage and coal and oil. I give that about I give that like a 3 out of 10 take. And okay, Shamath, we're talking about 2032. I'm talking about a 10-year cup and handle that's gonna break out for a 6-month 40 to 80% pump. Gonna make like $500,000 and then fucking dump it all into Bitcoin. Like I don't even give a shit what happens to 2032, Mr. Billionaire. So thanks for your insight, Mr. Billionaire. Shamath, you've triggered me more. I'm gonna go levered long now. No, I'm not.
That's it's been a great show for the roll up today. Be careful on leverage, boys and girls. Don't get liquidated. And if you don't get liquidated, then we'll see you tomorrow.
Yeah, don't get liquidated, guys. I hope you enjoyed today's show. There's tons of news to cover tomorrow. Rumor mill, more guests. Just stay positive, you know? If you're riding the charts out, look at Hyperliquid. Give yourself some faith. HIP3. It's the one to look at right now. Mahalo.